Hi, and welcome to the Global Listed Infrastructure Quarterly Update. I'm Amy Manns, Institutional Relationship Manager, and today I'm joined by co-heads of infrastructure and portfolio managers, McVicar and Ofer Karliner. Welcome, guys.
Hi, Amy.
Perhaps today you can give us an update on what's happened over the past quarter. What were the main takeaways?
Yeah, it's certainly been an eventful quarter. What seems like now a long time ago, Trump implemented his Liberation Day tariffs on April 2nd, combining that with white-handing Jay Powell and talking about musing about potentially sacking him. It kind of sent markets into a bit of a tailspin. He raised tariffs on China to 145%, talked about putting taxes on Chinese vessels docking at US ports. As all that was going on, we saw the MSCI World fall about 12%. For us, we saw a little dip in the funds initially, but pretty much very quickly we all returned to positive territory as the markets rotate to defensive assets. Obviously, the people trying to protect their portfolios, protect their wealth. Remarkably, as Trump backed down progressively by the end of April, MSCI World was almost back to flat. Saw continued growth through May and June, with June marked by a war in the Middle East. We saw a spike in oil prices as concerns that Iran was going to block the Straits of Hormuz, which is the key oil or seaborne oil traffic route. That didn't happen when Trump bombed Iran, obviously. So again, very eventful quarter. But through all of that, infrastructure did exactly what it was supposed to do. It was very defensive. We held up extraordinarily well. And it kind of really speaks to what we've spoken about for a very long time, is infrastructure, when it's defined correctly, should provide really good protection during periods of market uncertainty and economic dislocation. So the other key takeaway there is Trump and his erratic style is probably going to see more volatility going forward. Probably past the peak volatility, which is tariffs, but certainly I would expect more volatility than would be the norm over the next sort of 3.5 years.
It's great to see that our definition is performing as you would expect it to. So how are shifting US political policies influencing investment strategies?
Yeah, sure. Happy to jump in. So when we think about the portfolio and what we actually are thinking about in the US, we've probably got a couple of areas or a couple of types of assets that we hold in the market. So we've got some utility investments in the United States. We've got some communication or mobile phone tower investments in the US. And we've also got some freight rail businesses there. And as Ofer touched on, it's been a pretty eventful few months, particularly coming out of the US and the Trump administration. So a couple of things that really jump out that we've been focused on during that period of time. One is that everyone's been following this closely, is what's going on with tariffs. The other one then is where it's sort of shifted to is more the budget reconciliation bill, or the One Big Beautiful Bill, as it makes its way through Congress currently. And it's really within that a few key areas that we're focused on. One is the treatment of subsidies or tax credits on renewables, and the second one is effectively a foreign investor tax, or Section 899 as it's known. So I'll start with that last one first, because it's probably the simplest to deal with in a way. Section 899, or foreign investor tax, would have been an issue in the sense of when we think about how it might have implemented investors who held portfolios in the US. But importantly, from a portfolio construction point of view, it might have impacted some of our companies who held assets in the US but were non-US based. Pleasingly, that looks like it's not going to make it through to the final drafting. After there was some discussions at the G7 with the executive branch of the government, it looks like that's been moved away from, so that's a net positive in the movement. The next thing is really the tariffs. So tariffs, obviously we all know they were put on a pause, and in the near distant future they're going to be up for, potentially that pause is going to end. We'll see how that actually plays out. But as a reminder, how that actually impacts the portfolio and the assets we hold. So the tariffs had the potential to be inflationary for a lot of input prices. When we think about the assets we held, like utilities, you don't really expect a big impact on those types of businesses, because ultimately they have a model that's a pass-through, so they have the ability to push that onto their consumers and basically get that paid for. But not ideal for the consumers on the other end, but that's ultimately the way they can protect their franchise. Things like mobile phone towers, you might have seen some input costs there on steel and things like that, but it's probably going to be more around the margins. And then probably the one spot that we hold that might be more impacted is the freight rail, because a portion, not the majority, but a portion of their business is associated with international trade, and there could be an impact there. But probably more generally, the thing we're watching with tariffs and continue to monitor is the risk that it creates more broader economic disruption. It seems like we're sort of muddling through at the moment, but we continue to watch that. As a reminder, infrastructure tends to do relatively well in those environments, but still there is a part of the portfolio where economic strength obviously supports that. So we continue to monitor. The final one is kind of interesting, which is really that renewables piece I mentioned as a part of this budget reconciliation bill. The renewables are kind of interesting in that we had originally thought this was unlikely politically to be attacked, because ultimately a lot of these credits flowed through to Republican states. So there was a political calculus potentially involved here. But they've decided what they're going to do is phase these out over the coming years. Already we've seen some drafting from the Congress and the Senate around how that's ultimately going to be shaped, but it looks like we're headed towards phasing those credits out. And so what it will probably mean is that if you don't have your utility scale generation in place service by a certain date, that's going to not get those credits. But what it will mean as a market point of view is you'll see less investment probably in renewables, and because you won't get that same subsidy. But what's going to be interesting here is there's not too many great alternatives at the moment. You've got some aging coal assets, you've got some aging nuclear assets, and then you've got effectively renewables that are currently one of the lowest cost to serve type assets. Meanwhile, gas is really hard to get installed at the moment. So you could actually see the entire cost curve just lift a little bit in the US for this. So it's going to be interesting to see how that plays out. From a portfolio point of view, the utilities we invest in, for them, it's kind of one leg of growth. We've always said that it's the icing on the cake. It's not the whole story about these companies. These are regulated utilities. They can continue to invest in their networks, harden their assets, replace aging infrastructure. These days, you've got a lot of growth coming out of load from data centers, and they've got to cater to that as a system. So there's still a lot to like there. It's probably just incrementally slightly slower growth out of that avenue of their business.
And it'd be great to understand, how has infrastructure been holding up lately, especially with ongoing concerns around macroeconomic conditions and political stability?
Yeah, like I spoke about the last quarter, obviously this has been happening since Trump's inauguration. We saw a slew of executive orders, tariffs on Canada and Mexico, then off again, then back on again, tariffs on China, tariffs on steel, or at different levels. Through all that, infrastructure's done as we would expect. It's held up really, really well, performed really strongly this financial year, this period. It kind of comes back to the way we think about the world and why we define the universe. We are very focused on finding those businesses with robust cash flows that are really underpinned by a strong regulation or profound competitive advantage. It's really hard to shake those businesses with all this noise that we're seeing from the Trump administration, the changes in policy. That's why the sector's done so well. When it comes down to what we're trying to achieve, which is true diversification, and I think we said before, not all infrastructure definitions are created equal. You saw some of the things we exclude, some of those oil and gas exposed names, down over 20% in the space of a couple of days in April, and that really speaks to their economic sensitivity. It comes back to why people own infrastructure. You're owning it to create diversification in your portfolio. You don't want that same exposure you're getting from global equities. And as a consequence, when you strip out those really lower quality names, you end up with a high quality portfolio. You end up with that diversification, you end up with that defensiveness that you're really looking to achieve when you're investing in infrastructure. So it's really happy and glad to see it's done exactly as we would have expected to do during this period.
It has been an interesting quarter, but perhaps if we look ahead, can you share your insights on the outlook for infrastructure and where you're seeing opportunities?
Yeah, sure. So when we think about infrastructure, maybe it's just as a reminder, really the way infrastructure should perform is it should deliver reasonable but not excessive rates of return. But really importantly for infrastructure, these are the kinds of assets that should do it on a really strong risk-adjusted return basis, i.e. these are assets that have lower risk than typical industrial companies because you are, number one, heavily advantaged as a business. Typically you're a monopoly or near monopoly, and two, you're delivering essential services. So these are not the kinds of services you stop using just because you get an economic slowdown coming through. And so when we think about that as a scene setter, the types of opportunities within that we're seeing are really a couple of areas. One is we're seeing some opportunities in sort of one bucket where the market's probably not appreciating the opportunity for growth of some of these assets. They might be looking at what management are guiding for currently, but not appreciating the things that are coming down the pipeline, so to speak, around opportunity. And potentially that's got a higher opportunity attached to it. And so we're seeing a few of those opportunities. And the other thing we're seeing, and we talked about this in the past, is where we're seeing businesses where there's a broader industry level issue that's being dealt with. But companies themselves are underappreciated for just how high quality these assets truly are, and they're trading at discounts that are probably unreflective of that quality. And one example here that we've talked about in the past is the United Kingdom water sector, where we've seen a number of assets there that continue to look to us, really undemanded in terms of valuations. But notwithstanding that, you're dealing with these issues in the background that we think will just gradually be worked through as a system. And then that's probably where we're seeing opportunities at the specific level. At the higher level in terms of sort of the macro settings that they were looking at. Again, the environment to us looks pretty similar to more recent times where through the last recent years we've had a rate reset and interest rates are significantly high and they've increased significantly. Inflation's continued to abate. And off the back of that, to us, it looks like a pretty good setting for infrastructure. Valuations don't look demanding and you've got those settings. So for us, it looks well placed in terms of delivering against sort of the return objectives.
Okay, thanks Ben. Thanks Ofer, it's great to chat to you today. And thank you for watching. Please reach out to your Magellan representative if you need any further information, and do feel free to share this with your clients and colleagues. Thank you.